Another planning area that many widows begin thinking about through their financial transition is charitable giving. After losing a spouse, charitable giving can really feel like a natural and powerful way to promote an ongoing legacy that honors their late spouse. Whether it's a small donation to an organization that was important to them, or a large donation to fund a capital improvement project that puts the family's name on a plaque, or maybe even a scholarship fund in the late spouse's name. And charitable planning offers this deeply personal way to honor their life and values and create intentional, ongoing impact in their memory. And there are actually several strategies that can make charitable giving both more impactful and more tax efficient, especially during widowhood. One strategy we often discuss is something called a qualified charitable distribution, or a QCD. So once someone reaches age 70 and a half, they have the ability to give directly from an IRA to a qualified charity. And the benefit of doing this is that the money goes straight to the charity and it does not count as taxable income to the donor, even though it is a withdrawal from an IRA, and typically a withdrawal from an IRA would be taxable. The limit on these QCDs for 2026 for any one individual is $111,000, and that's going to rise a little bit every single year. So this strategy can be particularly valuable because retirees are required to begin taking required minimum distributions, or RMDs, from their retirement accounts, starting at either age 73 or 75, depending on the year that they were born. And that RMD age has changed a few times over the last several years, so we often hear a little bit of confusion about this. But using a QCD allows someone to satisfy part, maybe even all, of their required distribution for the year, while directing those dollars toward charitable causes instead of taking the money out and adding to their taxable income and having to pay tax on those withdrawals. Another strategy that can be helpful in certain situations is donating appreciated investments, such as stocks or mutual funds that have grown significantly over time. So rather than selling the investment and paying capital gains tax either now or at some point in the future, a widow can donate the shares directly to a charity, and that provides a couple of tax benefits. So the charity will be able to sell the investment without paying taxes, but as the donor, you now avoid any potential future capital gains taxes on the growth of that investment. And you may also receive a charitable deduction from that gift if you itemize your deductions on your taxes. So, and then for widows who want to be even more intentional and regimented about long-term charitable giving, it could also, in some cases from a tax planning standpoint, be appropriate to choose to establish something called a donor-advised fund. A donor-advised fund allows someone to contribute assets into a charitable account, receive a tax deduction in the year that contribution is made into this charitable donor-advised fund, and then recommend the grants to the various charities that they want to support over time, with a lot of flexibility around when those are distributed at the donor's discretion. So this can really just create a more thoughtful and structured way to support causes over many years. And I think where it's also really, really valuable is in some cases, we can bring in the children or the grandchildren in that process to help with that donor advised fund and be able to help instill the charitable values of the family into those younger generations. But the broader point is that for many widows, charitable planning becomes an unbelievable opportunity to think about impact, purpose, and legacy. And if we can implement that purposeful giving in the most tax efficient manner possible, we are preserving wealth that can be redirected to then create even more impact at some point.